Taxes destroy compounding wealth. A portfolio losing just 1 to 2% annually to taxes can cost millions over decades. The ultra wealthy know this, so they use a completely legal IRS-approved system to turn taxable investment income into either tax-deferred or tax-free growth. It's not a loophole, it's just the tax code. Hi, my name is Rajiv Rebello, founder of Colva Services. My work has been featured in Michael Kitz's Nerd's Eye View blog, Advisor Perspectives, Alpha Architect, and more. I help ultra-high net worth families, RIAs, and family offices design tax-efficient strategies. In this video, I'll show you exactly how insurance wrappers work and why most advisors just completely miss out on using them. So let's go ahead and get started. Let's go ahead and talk about the main problem that ultra-high net worth clients face when addressing taxes and how it really destroys their wealth over the long run for not only themselves, but for future generations. Let's go over some quick math. Let's look at two portfolios. Let's assume that they both have the same 6% annual return. The only difference is that one pays taxes each year and the other one is able to defer the taxes. Now let's look at what happens after 25 years of both portfolios. So I'm going to show you a quick little graph that just illustrates this to help drive home the point. So in this graph here, we have on the x-axis the number of years, 1 to 25, and on the y-axis we have the amount of wealth. They're starting with $1 million. Again, $1 million in each portfolio. The orange line is the tax-deferred growth versus the blue line, which is the taxable growth. The taxable growth is assuming it's in a taxable portfolio and they're paying taxes every year, versus the tax-deferred growth is they're deferring the taxes for 25 years. So we can see over time, the orange line, the tax-deferred growth, significantly compounds more, such that at the end of 25 years, the client has almost 21% more wealth after this time. So the value of just tax-deferred growth is significant. Now, what if instead of that tax-deferred growth, it was tax-free growth? What would that look like? So we're going to take a look at that in the next slide. Similar to our previous one, right? We had in the blue line, the taxable growth versus in the green line, the tax-free growth. Again, same portfolio, 6% return, right? The difference though is the compounding. After 25 years, we see that the green line has 65% more wealth. So just over $4 million versus just over 2.5 for the taxable wealth. And this is why compounding matters. And looking at tax-efficient strategies makes a huge difference. Again, not only for the ultra wealthy in their lifetime, but for future generations. So ultra wealthy families know that the importance isn't just to focus on the gross return, but to focus on the after-tax return, not only for themselves, but for future generations. And so taxes are this kind of silent drag and silent erosion that most investors unfortunately ignore. However, the biggest threat that the ultra wealthy have to long-term wealth isn't necessarily market volatility, it's from the friction that comes from taxes and fees, because every dollar paid in taxes is just a dollar that compound over time. So you might be looking at me and saying, hey, Rajiv, what is a solution? How can I protect my wealth from being eroded over time due to taxes and fees? An insurance wrapper helps do that. It helps provide a vehicle that structures your investment and makes it either tax deferred or tax free, so that over the long run, your wealth is compounding over time. You can kind of think of this wrapper as a specialized kind of retirement or wealth account. If you're familiar with retirement planning, you've probably heard of things like a traditional 401k or a Roth IRA. These are retirement accounts, but they're just vehicles to minimize the friction of taxes. And so an insurance wrapper, like the ones we'll be talking about today, accomplishes the same thing except for wealthy individuals, right? The traditional IRA and retirement plans are for the middle class and upper middle class, but the ultra wealthy have vehicles like insurance wrappers to help them maximize the value of their wealth over time. And these vehicles allow both, regular taxable ordinary income and capital gains to grow tax deferred. And when you plan it properly, they're not just tax deferred, they can be entirely tax free. So this is what the work that me and my team does for ultra high net worth clients, is that we design solutions based on their needs and based on their portfolio that help minimize the taxes given their choices, right? So let's go over quickly, how do these insurance wrappers work? Ultimately, all it is, again, like I said, it's a vehicle, it's a wrapper. So investments are placed inside this insurance structure, and once the investments are placed within this vehicle, the income and gains compound without the drag of annual tax taxation. And the benefit here is that the solution or the investments in these wrappers can be customized around the individual's needs, right? So if they want more risky assets, they can do that. They want more safe assets, they can do that as well. So depending on the client's needs, we structure a solution and an insurance wrapper around that investment strategy. So again, the wrapper is not a one size fits all. It's a customized solution to that individual client and their family's needs. And like we said earlier, the important thing about this vehicle is it allows for tax-free access. So not just tax deferred, but tax-free when planned properly. So let's compare this to other wrappers. We were talking about 401ks and IRAs before, but unfortunately 401ks and IRAs have contribution limits. Those contribution limits are on the individual's income earnings, right? So in order to fully contribute to these vehicles, you often have to be below a certain income. And ultra high net worth clients are well above that income amount. So they can't contribute as much to these vehicles, and it's not as meaningful because they have so much more wealth, and the limits limit the amount of tax-free wealth and access that they have. So other wrappers involve using trust to help manage these benefits, but the issue is that they manage the estate tax benefits, but they don't address income tax, and we need to separate the two. Estate taxes are different from income taxes. So trust can solve the estate tax problem, but they're not solving the income tax problem. And actually, smart estate planning combines the two. Use vehicles that help minimize both the estate tax and eliminate future income tax by combining the two. And we'll talk about that later. Unfortunately, taxable accounts, if you're just investing in a traditional taxable account, it offers no income tax protection here. And what's worse, if you're an ultra high net worth individual, if that grows, you're going to be subject to estate taxes if it's above the estate tax limit. So optimal planning involves using insurance wrappers with your estate planning strategy that combines tax deferral, tax-free access, estate tax efficiency, and higher funding capacity for qualified investors. If this is so great, if insurance wrappers are so great, Rajiv, why do advisors not use this strategy? Why are they missing out? Well, we're going to talk about a number of reasons why that is. The first is purely an education gap. CFP programs teach insurance purely as risk management, not as a tax infrastructure, which is unfortunate because CFP programs teach the value of wrappers such as traditional IRAs, Roth IRAs, solo 401ks. So they're actually talking about the value of wrappers, but they miss insurance completely. It's completely negated and missed to the side. So that's the unfortunate problem of CFP programs, is that they're geared towards only a certain type of wrapper. And unfortunately, that type of wrapper really only fits the middle class and upper middle class. They don't serve the ultra high net worth market well at all. The other issue is that CFA programs teach investment theory, right? How to maximize alpha and minimize risk, risk-adjusted returns, right? They're not teaching financial planning, or how do I house these investments within a tax-efficient wrapper, right? The tax-efficient wrapper, or the effective taxes, is looked as a back-end result. They're not concerned with it. They're concerned with front-end results. Return relative to the risk. They don't realize that taxes are a risk, right? So both these programs, the CFP program and the CFA program, miss out on a valuable tool for ultra-high net worth individuals. And that's a key reason why the use of insurance wrappers is not more widely utilized in the financial planning space. What we do here at Colva, however, is combine our actuarial knowledge with the financial advisory practice. So that way, ultra-high net worth clients are getting the best of both worlds. They're getting a wrapper that meets their financial planning and investment needs. Again, you have to look at this from a broader perspective than just purely investments or just purely retirement planning. It's combining the two, combining that with estate planning, and that's what we do. Most advisors, unfortunately, separate insurance and investment. They don't see how the two can be connected, and how insurance ultimately is just a part of the tax code that allows wealthy people to accumulate wealth. So when given this perspective, we can see how much value these products can have. The other issue that results in this gap between the value that these wrappers can have for ultra high net worth clients and advisors not using that is really behavioral bias, simply because decades of commission-based insurance sales rightfully created widespread advisor skepticism, in the sense that back in the day, and even to this day, a lot of products have high commissions, and those high commission products are not the best for clients most of the time. So what advisors were noticing is that the people selling these products unfortunately weren't acting in the best interest of their clients, so advisors and RIAs avoided it entirely. But that's kind of like saying, okay, I invested in one stock in, let's say Apple or crypto, and it went to zero, and does that mean that investing investing is no longer worth it. And so this unfortunate bias against insurance, right? And understanding that yes, some insurance products are not the best for the client doesn't mean that all insurance is bad. And the problem is that the people who should be able to understand and convey this are the financial advisors, but they're missing out on this due to their lack of education. So many RIAs avoid insurance purely due to the historical conflicts of interest in this space, right? One is the conflict of interest between how insurance products are sold, right? But the other is their own incentive, right, against using insurance products, because if clients are using insurance products, that's less AUM for them to charge their fee on. So this is a conflict. That means the only people selling life insurance products and educating people about the value of it are people who are really just looking to sell products. On the other side, the financial advisors and the individuals who should be planners are avoiding it because of their own conflicts of interest against using it. They can't charge their fee on it, as well as their lack of education on the topic. So the unfortunate result of this is that clients are not being educated on how to use these insurance solutions and wrappers properly. What they really need are advisors who understand both the value of insurance wrappers and how it's negatively sold, and being able to shift through the weeds and understand where the value is. One of the things we do here at Culva is I read a blog called Separating Value from Bias, purely to educate people on the value of these products and help them overcome their own bias and fears against it. The next reason why advisors are missing out on using insurance wrappers for their ultra high net worth clients is they just don't understand actuarial mechanics, right? They don't understand how a life insurance policy is designed, what the fees are in it, and more importantly, how to mitigate the fees. If you know what you're doing, you can eliminate the fees to a few basis points over the long run. So understanding how to do this is crucial to using these insurance wrappers properly, and most advisors don't know how to do it. And instead of, unfortunately, becoming educated on the topic, they choose not to use it entirely, right? So unfortunately, because of this, both the advisors are afraid of it. They're afraid of it in the same way. Again, I might be afraid of dogs if I get bit once. They just don't know, right? Like, it's through proper education and understanding that you get comfortable and are able to utilize it as part of a comprehensive wealth management plan. So unfortunately, most advisors are realizing that insurance does have some sort of value, the good advisors, but they don't feel comfortable with understanding and utilizing it personally, so they outsource it completely. And the downside is obviously you're losing control of that relationship. So what are the consequences here that we've been talking about and alluding to? Is that advisors are avoiding insurance out of discomfort. Ultra wealthy families need it, are continually looking to pursue and acquire it as part of a generational tax strategy for both themselves and their families. So ultimately, these advisors are missing out on opportunities because the ultra high net worth clients realize that they do need this solution, but they're going elsewhere. They're not going to their advisor because their advisor isn't educating them about it. And unfortunately, they're turning to the market. And like we talked about, a lot of the market are salespeople. So ultimately, what we try to get across at Culva through our Substack, Separating Value from Bias, is that it's not about selling products. It's about designing better financial architecture for clients. So let's go ahead and look at now a real world math example. So one of the best uses of insurance wrappers are to put the part of your portfolio that is tax inefficient in this wrapper. So by tax inefficient, we mean the part of your portfolio that is taxed the most. So for example, bonds are taxed heavily. That is a key part of almost everyone's portfolio that they use, but unfortunately on the back end, they're losing a lot to taxes, especially in places or in states like California that are taxed heavily, right? So not only are you paying high income tax, you're paying high state tax on it too. So we're going to look at it again, two portfolios similar to how we did earlier, of one investing in bonds within a taxable account versus investing in bonds within a tax-free wrapper of life insurance, and see what the effect is, right? So again, let's look at a high net worth investor who's holding 10 million in taxable bonds and see the effect of utilizing that same portfolio, that taxable bond portfolio, within a taxable account versus a tax-free insurance wrapper. So in both cases, we're assuming that portfolio is yielding 5% annually. So 5% of that 10 million is 500,000 in taxable income per year. Let's imagine that that's in a taxable structure, right? So if it's in a taxable structure, we're paying taxes on that 5% every year. So that 500,000 in taxable income, let's assume a 40% combined federal and state tax rate. Like I said, that's actually pretty low for clients in states with high state taxes, but let's just assume 40% to make some of the math here easier. So 40% on 500,000 is $200,000. So every year clients are making 500,000, which is great, but they're losing 200 grand of that. So leaving them with only a net 300,000. So that means what's compounding isn't the 500, it's the 300,000, right? And we saw the effect of compounding in our earlier graph. So we're going to look and now see, well, similar to what we saw previously, what happens when we put that same portfolio, that taxable or that bond portfolio, in a tax-free wrapper, right? right? What is the effect if that 500,000 is compounding within a tax-free wrapper or insurance wrapper versus within a taxable bond portfolio? And we're going to look at that here in this slide here. Again, we're comparing the taxable bond portfolio versus a tax-free bond portfolio within an insurance wrapper. So again, the blue bar graph is a taxable bond portfolio, and the green is a tax-free portfolio or bond portfolio, right? Same return, just within a tax-free wrapper. And we're putting 10 million in, right? In both cases. So after 25 years, the tax-free bond portfolio has about 50% more wealth. So $30 million versus a little over 20 million. So this is the value, again, of using appropriate wrappers and strategies for your investment strategy. So not necessarily changing your investment strategy, it's just doing what you already do, just more tax efficiently. And another thing we talked about, and we alluded to a little bit earlier, is the value of combining, right, estate planning with an insurance wrapper, because then you get the best of both worlds, right? It's free from the estate tax and free from income tax. So let's just look at that for a second in this little chart here. Again, combining estate planning vehicle with a life insurance wrapper creates tax-free generational wealth. So let's look at that here. So we have an ultra high net worth client and their beneficiaries. They're contributing an asset to an estate planning vehicle. From that estate planning vehicle, they're combining that with a tax-free vehicle. That could be, private placement life insurance, whole life, indexed universal life. And from there, they're investing in underlying investments, right? So the benefit of using this is that they invest in the underlying investments, and then when they want that money back, it's flowing back to them. The returns are flowing back to the vehicle, then flowing back to the estate planning vehicle. And because it's in this tax-free insurance vehicle, it's income tax-free. And because it's in this estate tax planning vehicle, it's free from the estate tax. So when it comes back to the client and their beneficiaries, it's free from both income and estate tax. And that's the value of stacking planning opportunities. And that's essentially what we at Colva help do. So again, combining an estate planning vehicle plus a life insurance wrapper helps create income and estate tax-free generational wealth. So what is the value of upgrading your existing tax architecture? Well, the first is that this isn't about selling insurance products. It's about educating clients about the value of tax efficiency in their infrastructure. So just like how you might optimize asset allocation, you're going to optimize tax structure. So you probably do this already. You put the tax inefficient parts of your investment in your retirement accounts to maximize the value of those retirement accounts. We're just doing the same thing with insurance wrappers, because insurance wrappers, you can put a lot more wealth into them than you can into retirement accounts. So insurance wrappers really are just one tool in that asset allocation optimization strategy. And so it does require a different mindset. So what the ultra wealthy realize is that accumulated a lot of wealth over their time. And so the next part of their journey is understanding how to manage that more within vehicles that help protect their wealth. And the tax code has multiple tools, some of which we talked about here with regards to estate planning and income tax protection, that benefit the wealthy. These are just tools and strategies that the tax code allows for the wealthy to help continue to accumulate wealth. And that's why for the ultra wealthy, it's more about using these tools to their benefit as opposed to chasing more and more risks when they already have tools to protect them. So reducing friction means reducing taxes, fees, and inefficiency. And every dollar that's saved here, like we said, compounds for decades, not only for themselves, but for their beneficiaries. And if you're an advisor to these clients, to ultra high net worth clients, being able to master this knowledge about how to use these wrappers really differentiates you from your competition. Because like we talked about, the ultra high net worth clients need this. They need life insurance planning. They need to understand generational tax wealth, right? Like how to create that. What are the best vehicles towards that? And life insurance wrappers are a key part of that. So being able to understand this helps position you as the advisor as someone who understands advanced wealth planning and how to use various tools at their disposal, as opposed to shying away from it completely, right? So understanding how to use these as wrappers opens up opportunities with ultra high net worth clients and family offices. So it elevates your existing value proposition beyond just portfolio management, beyond just saying, let me manage your assets and charge you a fee. It's really about high level financial planning. And if you're a sophisticated investor out there and your advisor hasn't been discussing tax efficient structures like this with you, I think it's valid to ask, well, why? Why isn't this being introduced to me, and where can I go to learn more about it? Because like we talked about, for the wealthy, investment strategy is only one part of the generational wealth equation. It's about using the tax code. It's about understanding tax efficiency from both income tax and as the estate tax. So now that you understand how the ultra wealthy use life insurance structures to minimize investment taxes, again, not as a loophole, but within an approved section of the tax code and part of a financial planning strategy. And that's really all this is how do we use financial planning tools more effectively, right? For the benefit of our clients. So if you're an advisor or family office who wants to explore how these strategies work for you or your clients, visit colvaservices.com to connect with my team, or you can click on the link below to book a call directly with me. And don't forget, of course, to subscribe to this channel for more content content on tax-efficient wealth planning. Remember, true wealth isn't just what you earn, it's what you keep.